All right, let's just jump right in with a number. A number that honestly sounds like it should belong to a country, not a crypto company. Yeah, you heard that right. 116 tons. That's the estimated amount of pure physical gold that Tether, the company behind the USD stablecoin, has quietly been buying up. And just to be clear, this isn't just some small side investment. We're talking about a strategic move on a global scale. A private company is stockpiling gold at the same pace as a central bank. It's a really big deal. And just take a look at this chart to see what we mean. Tether's private stash of gold is now right up there with the official reserves of entire countries. They've become a new whale in a very, very old market, practically overnight. Okay, so let's get into our first section here. How on earth did a company that's all about digital money become so obsessed with old school physical metal? So, if you look at Tether's own reports, and this is what they're telling us, you get a little peek behind the curtain. You see a massive pile of US government debt, sure, but then you get to the really interesting stuff. Gold and Bitcoin. Together, that's over 12% of the assets backing their stablecoin. But what's really wild is how fast this is all happening. In just one 3-month period, Tether bought more gold than any single central bank on the entire planet. They're a new force that can actually move the gold market. It's pretty stunning. All right, that brings us to our next section. And to really get why they're buying all this gold, we've got to back up a step and talk about what Tether, or USDT, actually is. So you've probably heard the term stablecoin. Well, USDT is the dominant one. The easiest way to think about it is as the US dollar for the crypto world. It's the basic plumbing that lets traders move value around super fast without ever having to touch a traditional bank. So on paper, how's it supposed to work? It seems pretty simple, right? A customer gives Tether $1, Tether creates 1 USDT. But the real story, all the controversy, is buried in step 3. What exactly is Tether doing with all those dollars they're holding? And this right here is a really important point. You could call it a key knowledge gap. We don't get a full audit of Tether's books. We get something called an attestation. So what's the difference? Well, think of it like this. An audit is like a doctor giving you a full physical exam over an entire year. An attestation is like taking a selfie on New Year's Day and saying, see, I was healthy. It just proves things were okay at one specific moment. Okay, so this is where the story gets really, really interesting. It turns out Tether isn't just holding one giant pile of gold. Nope. They're actually running a 2-track strategy with 2 separate stashes for 2 totally different reasons. Right, so on one side, you've got about 12 tons of gold that directly backs a different Tether token called XAUT, which is supposed to track the price of gold. Simple enough. But then there's the other side, the much larger pile of over 100 tons. And that gold is being held as a portfolio investment, using the reserves that are supposed to back their main dollar stablecoin. And this chart really breaks it down for you. About 3/4 of their portfolio is in pretty safe stuff, US government debt, cash, that kind of thing. But it's that other 25% that gets all the attention. It's what rating agencies have called the spicy part of the portfolio, a mix of gold, Bitcoin, and other investments that are, let's say, a bit more volatile. So here's the first big analogy for you. It's helpful to stop thinking of Tether as just a simple digital bank. It's really operating more like a massive macro hedge fund. It's taking customers' cash and using it to make huge, profitable bets on assets like gold and Bitcoin. So as you can probably guess, when you start acting like a giant hedge fund, regulators and rating agencies are going to start paying attention. And, well, not all of that attention has been positive. Take S&P Global, for example. They are clearly worried. They gave USDT their lowest possible stability score, a 5 out of 5, which is not good. And their concern is pretty simple. What happens to a supposedly stable coin if its risky investments like Bitcoin and gold suddenly crash right at the moment everyone is trying to cash out? But Tether's leadership, they see it completely differently. Their CEO's response to that downgrade was basically, we wear your loathing with pride. From their point of view, this strategy isn't adding risk, it's reducing risk by diversifying away from a complete reliance on the traditional US dollar system. So that's really the core of the whole debate, laid out right here. You've got the bull case from Tether's perspective. They're building a stronger, more resilient system for the future. And then you have the bear case from the critics. They're building a black box of risk that could put the whole crypto market in jeopardy. Okay, last section, let's bring this all home. So what does this all mean for the markets and, for anyone who actually uses stablecoins? Well, for one thing, it's created this strange new feedback loop. When crypto markets are booming, Tether makes a ton of profit, and it uses that to buy more physical gold. That could actually push gold prices up. But it works in reverse too. A big crash in the gold market could now, for the first time ever, directly threaten the liquidity of the crypto market. The two worlds are now connected. So how are they planning to deal with all the regulatory heat, especially from the US? Well, here's our second analogy. Think of it like a car company. They'll keep selling their high-performance sports car, that's USDT with its spicy reserves, to the global market. But for the US, they're going to offer a totally separate, safe, regulated family sedan. So the bottom line for anyone actually holding USDT is this. You have to understand what it is and what it isn't. It is not a bank deposit, it carries risk, its reserves are managed more like a hedge fund than a boring old money market fund. And while its dollar peg has been pretty solid so far, past performance is no guarantee of future results. So maybe the best advice is just to not put all your stablecoin eggs in one basket. And all of this leaves us with one big fundamental question. When a stablecoin is backed by billions in volatile assets and is making billions in profit, where do we draw the line between a simple currency peg and a high-stakes hedge fund? The answer to that question is going to shape the future of digital money.